back. So, you get close to the microphone. It's weird being on camera and talking into this. So, I'll address real quick a couple interesting things to be investing in. Streaming wars, we got Netflix versus Disney versus all the others. I like Netflix the most. I like Roku and Netflix. Those are my favorite streaming things. And I've kind of explained why that is. This whole Corona situation, digital wallets, I think this is going to push kind of cardless, cashless payments forward really fast. I mean, I still think like companies like Visa and stuff like that. Visa's actually a really good company because they bought a company called Swipe or so. It's a company that pretty much gets money every time some of these digital assets are transferred. PayPal and Square, I think, are really good stocks. PayPal and Square deals with business, point of sale systems, and those things you swipe on your phone. That's good in itself, but they own Cash App, which allows you to do investing, Bitcoin, and do those little transfers between your friends. And PayPal owns Venmo, which is a similar one. So both of those are incredibly popular, and I think fintech is one of the spaces that is a really good space to be in for the future. Social media, other than the current king of Facebook, I think, even though Facebook's maybe getting down some prices that are more attractive right now, I just think LinkedIn has a really good potential. But it's owned by a company called Microsoft, which is a huge company. So LinkedIn's success is really not going to change the course of Microsoft as much as if it was by itself. I wish it was a stock unto itself. I'd be a lot more excited. I would definitely buy some LinkedIn stock. LinkedIn bought a company called Lynda, which does a lot of education. So I think LinkedIn actually is a good play on some education. But like I said, it's all wrapped into Microsoft, which it's just a good company to invest in, but you're not getting a pure play of education or of social media. Maybe one day they'll spin off LinkedIn, but I don't feel like. I think Twitter is actually one of the best priced. I think there's going to be some things going forward that are going to change about Twitter, and I think they have potential to become a lot bigger than they are. They've been very stagnant for years, and I think people have come in and they want to change that real fast. TikTok, can't invest in that right now. That is owned by a company called ByteDance, and TikTok's a really cool platform, but it's owned by ByteDance, which is also owned by a company called SoftBank, or ByteDance is invested in by a company called SoftBank, but ByteDance, I think, is going to go public soon, so I think that is something to keep your eye on, very interesting. Two things that are actually getting thrust forward with all of this virus is robotics. With social distancing, unfortunately, I think robotics is going to be sped up. Well, I like robotics, but robotics in the sense of displacing workers, like Amazon warehouses and different jobs. I think when companies do the estimation, they're like, we're having to pay these workers this much while they're out of work, we're having to do all this stuff, we don't have to deal with this headache. If we had a fully robotic factory, guess what? None of our stuff gets interrupted. So I think robotics is going to take off more through this. 3D printing, I think that's going to take off more so that you can prototype stuff really fast and produce spare parts. Right now, with all these ventilators being in such short supply, and our supply chain is all in other countries a lot, that's why we can't get some of the supplies we need. I think a lot of critical industries will get brought back to the United States so that we have access during dire times. And 3D printing, I think, will really take off so that we can have instant access to critical things. So I think 3D printing is something that really hasn't boomed lately in a long time, but it's more of a speculative kind of thing. But I think it's really going to take off. Energy prices have gone way south. Gas has gotten down to like $20, $19 a barrel, which is insane. But I was listening to something earlier. I still don't think that's going to derail electric cars. I think we're still going to see that progression, especially as these legacy car makers like Ford and GM are struggling right now. They're going to have to decide whether they're going to, which I think would be a terrible idea for them financially, whether they're going to slash all the electric car stuff because they really don't make a lot of money on it right now, or if they're going to pivot fully to electric and really push forward. But I think Tesla has a huge advantage. I think gas prices are going to go back up, so still give incentive, and electric cars have the potential to be way cheaper than even the $20 gas with how much it costs to top them off. And I just think Tesla, they are a smaller company, they have less factory, so they can I think they will fare better through all of this, and they really they don't have a dividend. Like I said, Ford's dividend is going down, GM's, I think they're going to slash theirs. All these companies are very, they've got unions that are kind of going head to toe with them. Tesla doesn't have a lot of this stuff, so Tesla doesn't have as much of the liability, and being a sleeker company, I just think they're going to come through this a lot better off once. And they're hunkered down in China, which China's already getting over this virus, and they've already ramped production back up in China. So they got cars rolling out. They can start having demand coming back from consumers there. So the fact that Tesla is got multiple bases in different countries really puts them, if there's an economic crisis in one area, it lets them be able to shift their focus to another area so that they're still making money. GM has an 8.4% dividend right now, which I don't see them keeping. Tesla's got that Shanghai factory, which I think is going to be crucial for them, and they've pretty much started doing at that factory a full production capacity ramp up. And Tesla puts most of their money back into research and development, and these companies just don't. They've been set up to put it in a good way, into employees, but also into the shareholders' hands. And so they're not really set up to be crazy innovators anymore. And they had about 100 years of good times where they were the kings. And so it makes you lazy, and it makes you, that's why you have to disrupt yourself. And they just quit advancing. And someone was able to come up behind them going 90 miles an hour while they were cruising around at 40. So they're going to get past. And so in this time, I think it's crucial to be very careful with highly levered, in-debt companies. Look at their balance sheets. Look at companies that are investing heavily in R&D instead of buybacks or shareholders. And you want to be with companies that are looking to the future. So I just think those are some things to pay a lot of attention to with stocks. Now, I'm going to give a few stock ideas. This is just my opinion. And right now, there's a lot of American companies like software as a service and some different companies. But I thought I'd take a different direction into a kind of an opinion I haven't really heard discussed lately, is that everybody's kind of looking at U.S. But I think we have a long road to recovery right now. And there's a country that is on the downhill of this, that is getting over it, that still has suppressed stock prices, and that's China. And a lot of their really good companies are down a lot, and I listed out some of the main Chinese companies that I'm aware of, and I went through on Yahoo Finance, and I kind of looked at a lot of the stats and stuff on them, and I filtered out, like, there's companies like Beozun, which is like the Shopify of China, which here I love Shopify. I think that's good stock. But Beozun, Alibaba, and JD. Those are three companies. They're good stocks, but I think those are stocks. I took notes on this, is to hold out for a while. I think, in my opinion, because they're based on commerce, and I want to see how a lot of stuff settles out, especially if we start bringing more commerce back to the United States, trade war. You've got, and people just like Alibaba, Beozun, I think Beely might. I don't think they are. JD, they are very much, a lot of their customer base is in the United States. I mean, they sell obviously to Chinese people, but if we are going through a huge financial headache right now, then even if their economy is getting better, those companies are still going to struggle for a while. So I think they're going to go even lower, or they're just going to go sideways for a while. So I'm not in any hurry to get into some of these commerce stocks. Although Alibaba is a really solid company, so I might start teasing a little money in with them. But they're down quite a bit. They haven't been for a while, but I think the better plays in China are companies like Tencent, Huya, Baidu, Momo, and Tencent Music, Weibo, and Douyu. And I'll go through those real quick. Tencent is a big conglomeration company that owns a lot of like gaming, game developers. They do like Fortnite. They do a lot of different things, and it's a really big company in China. But they have a lot of services, and they're not big into like e-commerce and stuff like that. That requires. They do a lot of services that are popular in the United States, that are popular in China. They are at $47, and their 52-week range is $40 to $53. So they're not that cheap right now. They have a 35 PE ratio. They're not that cheap, but they are down a little bit, and I think it's a really solid company, that good earnings growth. Huya, they are $15 right now, and their 52-week range is $12 to $28. So they're down a good bit. They're down by about half. They're not. They're a little above their low. So I think that's a good company. They don't make money yet, but they're growing very fast, and they're big in esports and gaming, stuff like that. I think esports has a lot of potential in the future. Baidu is like the Google. I compare a lot of these companies based off of our American companies. Beozun being like Shopify, Alibaba is like their Amazon, and iKiwi. I don't recommend that right now. They're not making good money. They're like the Netflix of China, and Baidu is like the Google. They are the biggest search engine in China, and they are $97, and their 52-week range is 82 to 186. So they're very low and the companies I recommend, they're all making good money, and they're showing a lot of progress year over year. Momo, that's another kind of gaming entertainment app, and they're at $20 with a range of $19 to $40, 52-week range. So they're on the low end. They make money, and they're growing very fast. And Douyu, they don't make money. They're on the very low range. Like gaming, esports company, and they're growing very fast, so have a lot of potential. 10 Cent Music is doing very well. $10, 9 to 19, 52-week range. I recommend them. And Weibo is on their low end of the range. $32, 29 to $72, 52-week range. So I think a lot of those companies are ones to really look out for. That's Douyu, Weibo, 10 Cent, Momo, Baidu, Huya, 10 Cent. I think those are some exciting ones just to keep an eye on. I don't recommend them, but definitely some of the more promising Chinese stocks. And I just think that's an interesting space to look at right now. Taiwan Semiconductor, I want to look into that because that whole area is just seeing a recovery right now. So I just feel a little more positive about some of those areas where I can see light at the end of the tunnel than areas here where we don't know how long these companies are going to slog through some of this mess. So, but I think it's important to stay away from some of those Chinese stocks that have heavy exposure to the U.S. as far as e-commerce and shipping. So those are just my recommendations. And thanks for checking out this podcast, and hope you like the video format. And we'll see you next week.